Okay, picture this. Your audit team has been absolutely grinding for weeks. They've waded through just mountains of invoices, tested incredibly complex algorithms, and scrutinized inventory counts until their eyes crossed. But now the heavy lifting is done, and those files, they're sitting right there on your desk. Welcome to this explainer. Today, I really want you to put yourself directly into the high-stakes shoes of a signing audit partner. We're talking about the completion and review phase. Your professional reputation, your firm's liability, and honestly, the trust of the financial markets are suddenly all on the line. This phase isn't just some administrative formality, it is literally the ultimate quality control mechanism before an audit opinion gets released into the wild.
So, the audit files are closed. Are you ready to sign? It sounds like such a simple question, right? But as the signing partner, you are the ultimate gatekeeper. Your signature is not just a quick scribble of ink. It's a guarantee to shareholders, to regulators, and to the public that these financial statements represent a true and fair view of the company's health. The immense responsibility of applying that final signature means you cannot just assume your team did the work correctly. You have to prove it to yourself. You have to run the gauntlet of the final review.
Okay, let's dive right into this. To get to that final signature, we have 5 strict hurdles we absolutely must clear. Final analytical review, evaluating subsequent events, assessing going concern, uncorrected misstatements, and finally, management representations.
Hurdle number 1, final analytical review, the drone view.
When you're in the thick of an audit, your team is way down in the weeds looking at individual, granular transactions. But now, we have to elevate. We need a drone view to ensure the aggregated overall figures actually make logical sense. Step 1, we take the absolute final draft numbers for management. Step 2, we compare them against our own cumulative audit knowledge. Think about it. Throughout the audit, we've learned all about the company's market, their struggles, their big wins. We have a really solid expectation of what these numbers should look like. And step 3, if the final numbers don't match our expectations, well, we can't just shrug our shoulders. We have to corroborate those variances. We have to dig back in and find out exactly why reality differs from our calculated logic.
What's really interesting about this is the incredible tension it creates. On one side, we have our expectation, the reality we meticulously constructed based on months of hard, objective audit work. On the other side, we have management's final reality, the story they want to present to the world. When these two sides completely clash, alarm bells should be ringing loudly. Like, if our audit work suggested revenues would be totally flat, but the final draft shows a 20% spike, we have a massive problem to resolve before our pen ever gets near that audit report.
Moving on to hurdle 2, evaluating subsequent events, the ticking clock.
We are now in that seriously nerve-wracking time period between the official financial year-end date and the moment the financial statements actually go public. And notice how our responsibility totally shifts as the clock ticks. Between point 1, the year-end, and point 2, the day we sign the audit report, we have an active duty. We have to actively hunt for new events, things like lawsuits, bankruptcies, or disasters, that could impact the final numbers. But between point 2 and point 3, when the statements are actually issued, our duty becomes passive. We don't have to keep aggressively searching. However, if management brings a massive issue to our attention during that window, we are absolutely forced to react, reevaluate, and potentially even recall our report.
During this ticking clock period, we basically sort what we find into 2 buckets. First up, adjusting events. These are things that give us new evidence about conditions that already existed at year-end. For example, say a customer who owed us a ton of money at year-end officially goes bankrupt in January. That forces us to physically alter the numbers and write off the debt. Then you have non-adjusting events. These are entirely new conditions. Say a warehouse burns down completely in February. Now, that doesn't change the inventory value back at year-end, but shareholders generally like to know if the factory producing their profits is currently a pile of ash, right? So that requires a highly descriptive note in the disclosures.
Hurdle number 3, assessing going concern, the ultimate survival test. If you want to talk about high stakes, this is it. The big existential question of the entire audit. Does this company actually have the financial ability to survive the next 12 months? As the signing partner, you are constantly scanning the horizon for glaring red flags. Severe cash flow shortages mean they literally can't make payroll. The sudden loss of major customers means revenue is just going to crater. Looming debt defaults could trigger a bank to pull their funding overnight, or maybe there's an uninsured catastrophe that wipes out their main production facility. Any single one of these points indicates a company teetering precariously on the very edge of financial ruin.
But hey, the evaluation isn't just one-sided.
We must pit those terrifying red flags directly against management's proposed survival plans. In one column you have the crisis, in the other, management pushes back. They might say, yes, we have a cash shortage, but we are finalizing a massive new bank loan tomorrow. As the auditor, you have to perform an incredibly subjective balancing act here. You have to ask yourself, are management's mitigating factors actually realistic, or are they just hopelessly optimistic pipe dreams? Because if we don't buy into their survival plan, we have to significantly modify our audit opinion.
All right, hurdle 4. Uncorrected misstatements. Dust under the rug. So, throughout the audit, your team is going to find errors. Most of the time, management just fixes them, but sometimes they stubbornly refuse. Everything hinges on this one concept, the materiality threshold. This is our absolute line in the sand. It's a calculated number, say 5% of profit before tax, that determines if an error is significant enough to actually alter a shareholder's economic decision. If an error is below this number, it's considered immaterial. But as the gatekeeper, the crucial point is you cannot just look at these uncorrected errors in isolation. Think of it like this. That first bar is the aggregate, the sum total of all those individual, seemingly harmless, immaterial misstatements. A little missing expense here, some slightly overvalued inventory there. If management refuses to fix them, they start to stack up. And if that stack grows and breaches the second bar, our ultimate materiality limit, boom, we have a crisis. The financial statements as a whole are now materially misstated. At this point, the partner has to draw a hard line and demand adjustments, or else issue a qualified audit opinion. And finally, hurdle number 5, management representations, getting it in writing. This is where we secure the final piece of the audit puzzle. A written representation is exactly what it sounds like, a formal statement provided by management to the auditor to confirm specific matters or support other audit evidence. Now, I want to be abundantly clear about this. This document exists to support our audit work. It is never, ever allowed to replace hard, independent audit evidence. Actually, scratch that. We can't just ask management, hey, is your inventory accurate? Get a written yes and call it a day. We need proof. But for areas involving highly subjective management intent, like their plan to hold a specific asset for the long term, getting this letter is absolutely vital.
You are going to see this classic boilerplate quote in virtually every single representation letter. We have fulfilled our responsibilities for the preparation of the financial statements. We require management to sign off on this specific language so they formally acknowledge their ultimate responsibility. Because look, if something goes catastrophically wrong later on, they cannot point the finger at the auditors and say, well, you guys prepared the numbers. No way. Management owns the numbers. We just audit them.
Think of the written representation as your absolute final safety net against hidden liabilities. We are forcing management to confirm in writing that they have given us access to every single record, every single contingent liability, and every single case of known fraud. Pinning management down with their own signatures is literally the final, essential defensive maneuver we execute before we are willing to attach our signature to that audit report.
And so that brings us completely full circle. You've completed the analytical drone view, you've survived the ticking clock, you've stress tested the going concern, tallied up all the uncorrected dust under the rug, and you secured management's promises in writing. The heavy lifting really is done. You've rigorously followed every step, but you know what? That unshakable burden of professional judgment, it is still yours alone to carry. So before your pen finally touches that paper, ask yourself, is your signature worth the risk?